Timothy, first of all, welcome to India and thank you for joining us.
Thank you so much for having me.
You're sounding bullish. Everyone is sounding bullish. And typically when everyone is on the same side of the boat, prices are not great. Are we going through a period of too much of consensus on the growth side globally?
It's a great question, and it just shows how rapidly things change, because just a short 3-4 weeks ago, the market was obsessed with an inversion of the US yield curve, which is typically a harbinger of recession. So there was lots of concern about growth falling and US going into recession and nobody having any confidence in growth. So a short 3 weeks later, we've had better US data, we've had exceptionally strong data in China, and so our own indicators of global growth show the global cycle is picking up, and I think more people are becoming more confident about global growth. But I would add to that in our interaction with investors, we're not seeing signs of excessive optimism. In fact, what's surprising is that we've had this very strong recovery in markets, especially with the S&P hitting a new all-time high last night, and yet retail investors have been net sellers to a large degree, nearly $100 billion in the US this year. And we see, for example, closer to home here in India, that retail investors have been quite cautious and only just recently beginning to come back to the market. So overall, our sense is that the signs of euphoria that typify, as you correctly said, a market peak are still not objectively in abundance.
So everyone is feeling, you can smell the bull market, but perhaps you're not feeling the bull market because there is no participation.
I think that's right. And I think I'd just like to qualify things. I mean, yes, markets have done better this year and have recovered after a very significant shellacking last year. To give you one statistic, for the broader Asia Pacific ex-Japan regional index, last year it was down 16% in US dollar terms, the fourth worst year in the entire 32-year history of the index. So a pretty bad time. And against that very oversold condition at the end of 2018, we've recovered sharply. But we've just come back, in our view, to kind of fair valuation, not overvaluation. And I think the speed with which the recovery has happened, frankly speaking, has caught many investors off guard, either professional investors or retail investors. And we can see this through the data. We can see, for example, just to give you one other statistic, we look at a universe of nearly $2 trillion US of global mutual funds, and they are in aggregate underweight the Asia ex-Japan index by 600 basis points, which is a lot.
Everyone's been making a case that earnings will come through. It could be a variety of factors: demonetization, LNFS crisis, GST. Bottom line, earnings are not growing. Do you think this year it could be elections which could just push us back? The decision making may get delayed and that could have impact on earnings?
So our expectations that earnings will pick up this year and next. And to give you our numbers for the broader index, we're looking at about 16% growth this year and 14% in 2020. So let's call it 15% on average. That's below the consensus, which is more about 20%. So we still think the consensus may be a little bit optimistic, but the key point we're making is that the absolute level of growth, which is likely to manifest, will actually be the best of any of the 11 markets that we cover across the Asia Pacific region. And I think in part it's because of, at least this year, of an easy base of comparison, because last year there was a lot of write-offs in the banking sector, as we all know. But in part we think it's going to be somewhat of an improvement in the economy and maybe the flow-through effect of some easy monetary policy, which typically is better for growth and also helps earnings. So we are constructive and hopeful that things can improve. Now, lest that sound like overly optimistic thinking, because I'm sure you're saying, well, I've heard that so many times the past few years. We do keep a close track on the quarterly earnings, and the one encouraging recent data point is that for the recent earnings reporting season, which would be the fourth quarter of calendar year, the third quarter of India's fiscal year, if we look at the actual results relative to the consensus forecasts, it was the best quarter in terms of beats versus misses that we've seen for, I think, the last 16 quarters. So there is some sign that the earnings in absolute terms are beginning to stabilize, and also that the overly inflated expectations have come down to more realistic levels. So that's giving us at least a little bit of confidence that the earnings picture might actually begin to improve.
Now, you did not mention anything specific to elections in the presentation, but we know that election in the short term will be in binary event,
Sure.
5 to 10%.
Right.
So, what to your mind Indian markets currently are pricing in? It's important to figure out the mind of the market.
Oh, no, absolutely. So we have done some research on this, and again, I don't hesitate, I emphasize that we're not taking any view on the outcome of the election. That's not our job. What we can do is observe and analyze how has the market traded elections in the past. And the key point from the analysis that we've done is that if you look back at the last 6 election cycles, the market typically rallies into the election and then stabilizes after that. And actually, sometimes about 2 or 3 months after the election may have a little bit of profit taking. So generally it's sort of, kind of buy the rumor, stabilize, and maybe, take some profits afterward.
So hypothetically, if markets fall after the election, if they don't like the mandate, I'm not getting into the nature of the mandate,
Indeed.
but just the mandate, would you give a loud shout to your clients, say that, look guys, go and buy India, suddenly there is a Amazon sale?
Yeah, I mean, I don't want to anticipate what we would do. That's a little bit hard to say because we don't know exactly the nature of the circumstances there. But maybe I'll reframe your question slightly and say that given the current setup, and if nothing changes in the current setup of expecting the economy to continue to gradually improve as it responds to the reduction in interest rates and so forth, and if we do indeed see the earnings beginning to come through as we expect, and at current levels of valuation that we view as fair, they're full, but they're supportable for various analytical reasons, then we would think that if the market had some sort of a shock, that it would start to appear better value, and indeed it would look like a decent entry point.
Okay, just a couple of last questions. Now we've got as a channel, we've got ears close to the ground. We know the mood of the domestic investors, what domestic fund managers are doing. But you have a pulse of what the foreign flows are. And this year in India, in the month of March, I read a report of yours just on Monday. It mentions that we've got $6 billion.
Correct.
That's Goldman Sachs internal data. Why do you think that money has come to India?
Yeah, so as you said, I think we do try to make sure we're having a pulse on the foreign investors' view on India, both through objective data, looking at mutual fund positioning and fund flows in the Indian equity market, which is accessible to everybody. It's published by the stock exchange. And then we complement that with some empirical anecdotal evidence from the many conversations that we have with investors. And I think I can share a few things. First, the empirical data shows that foreign investors have been quite overweight India for many years and gradually brought that back to just slightly above neutral. So they were going from, call it 600 basis points overweight, which is a lot, down to pretty much neutral or just 100 basis points overweight. So foreigners had really kind of brought their very bullish India view back, which means that they've got a much sort of better base to kind of re-engage in the market if they begin to become more constructive.
What could be the next big compounding sector, both for earnings and for P multiples or for valuations for next 5, 10, 15 years?
Well, this is a great question, and I can't go into any specific companies and so forth, but I'd say, generically, as you just said, you want to be focusing on the areas that can really deliver visible secular compounding growth. And generally to do that, it has to hit parts of the economy that are growing better. And structurally so. So I think one sort of generic area to be focusing on has to be the rise of sort of the middle class. There's a great demographic dividend India will enjoy. There's a great, traditionally, if you look at the pattern of countries as they go through various stages of development, you hit inflection points in per capita income that result in shifts in consumption patterns, and there are a great many Indians either from the rural, semi-rural areas that are just kicking into that sort of inflection point, which should mean that businesses that are focused on delivering goods and services to that rising consumer cohort should have a lot of structural growth ahead of them.
Fantastic. Enjoy your stay in India and certainly look forward to much more with you going
much.
forward. Thank you so much. Wonderful.